These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will enter a bank reconciliation into our bookkeeping problem in Excel, keeping in mind how that same information could be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We will first take a quick look at QuickBooks and then jump back over to Excel and enter the data there. When considering QuickBooks, we have a feature to allow us to conduct the bank reconciliation. That starts with choosing the account. We're going to choose the checking account, and then we're going to put in the date. We're first going to reconcile the first month. So remember, we have 2 months worth of data now. We're going to go back and reconcile the first month and take a look at some of the problems that can happen in making adjustments in that case, if there's a problem and we need to make some adjustments for the prior month. And then we're going to have the beginning balance and the ending balance and enter that information. Once we do that, we could say continue within the QuickBooks software, and it really just gives us a detail of our banking information, which of course is similar to our general ledger, listing out the date of the transaction, the checks for the transaction, and the amounts. We can then compare those to our actual bank statement, and all we're going to do is just check off these information. We're going to check off everything that's on the bank statement to what is on the books here, and everything that is similar we're going to say has cleared by checking that information off. Everything that has not cleared then will be unchecked, and that's how QuickBooks will generate the bank reconciliation. So we'll talk more about what that is when we put this into Excel. But just note that we'll do the same for the deposit side. We're just going to say here's the QuickBooks data, and we're just checking everything off, and we're going to match that over here. This is going to be our bank statement, and we'll just tick and tie this out. This will make more sense as we do this in Excel, but it's just a quick example of what the QuickBooks looks like as you're doing this bank reconciliation. And once you have done that, we're going to identify anything that's going to be on the bank statement that is not on the books. In this case, we have these 2 items that were on the bank statement, not on the books. When working with QuickBooks, then, we would just make the adjustment, meaning we would go into the account and actually in the check register, make an adjustment, enter the data for anything that's on the bank statement that's not on our books. And we would enter that data and then go in and check that item off. We'll do the same for any other item. The bank service charges, we'll actually go to the check register and enter that data and then go in and check that off. This will again make more sense as we work this in Excel. And then once we're done, it'll indicate that we have been reconciled, in that we'll have a 0 in the differences column down here on the bottom. And in essence, it'll generate a bank reconciliation based on that information. So in order to get a better understanding of what is actually happening and what is a bank reconciliation and how did that generate a bank reconciliation and why do we need to do that, we'll put this information into Excel. Here we are back in Excel. We are going to do the bank reconciliation for January. So remember, we're at the end of February and we didn't reconcile the bank account as of the end of January, and now we're going to do the 2 bank reconciliations back to back in February and talk about the pros and cons of doing something like that. What we're doing is we're going to be reconciling the bank account, and that means we're looking at the bank statement and just tying out what the bank statement has to what we have. And if you would think that if we were going to look at the same date as of, in this case, the end of January, you would think that the balance at the end of January would match on the bank statement as to our books if everything was done correctly. But that's not going to be the case because of timing differences, meaning checks that we wrote that haven't cleared the bank and also deposits that haven't cleared the bank. Therefore, we want to reconcile those items, and we want to do that for a big reason. One, to check our cash account, obviously, because the cash account is very important. But also by checking the cash account, because the cash account is involved in the accounts receivable cycle, within the payable cycle, within just about every cycle, in the accounting process, we're really given a good check on every cycle within the process. So, and the fact that it's being checked against a bank, which has very good bookkeeping services and is often very accurate, means that it gives us a lot more verification to all accounts. So it's really our second best line of defense in terms of catching any errors within the double entry accounting system, other than simply the debits and credits, the double entry accounting, the balancing system itself. So we're going to go ahead and match this. What we're going to do this now, we're going to go to the bank reconciliation. It's going to be all the way to the right. We'll see a bank reconciliation, so we'll take a scroll all the way to the right, looking for the bank reconciliation area. And we will see a bank statement that we're going to then compare to our books. So it's all the way over here in the columns DW through EK. So DW through EK, that's what we will be working with here. And what we have is a bank statement on this side, and then we're going to have, this is the GL account. So first, bank statement. What is it? We've all probably seen a bank statement. We're going to get it at the end of the month. It's going to come directly from the bank. This isn't something that is from our books. It's from the bank. So this is what the bank says that we have. And it will generally have a beginning balance. It's going to have the additions in summary, and then any subtractions in summary, and then the ending balance. This for the month of January, the first month of operations. And then it usually gives the detail, meaning we've got deposits by date. Here's the date of the deposits. And then we have the checks here by date, and we also typically have check number and then the amounts there as well. Any other withdrawals or any other activity. In this case, we have withdrawals and bank service charges to get to our total in terms of the deductions and our total additions, which are these items here. So what we want to do is look at all this information and be able to tie it out to what we have. If we can double check everything, if we know that all these items, for example, are on our books, then we can be pretty confident that those are correct because they're also on the bank, and that gives us assurance that they are okay. In order to do that, we're going to take a look at the general ledger, the activity for the banking for January. So note that we are looking for the month of January rather than we are in currently now, the month of February. And therefore, where did we get this information? Went back to the first tab. So this tab over here went all the way back to this tab, the trial balance first tab. And we picked up this is the 94,437 at the end of January. And we're picking up the GL, all this activity, the GL that made up that 94 amount right there. So that 94 is being generated from here. And all the detail is this. So this is the activity we have. Going back to our trial balance for February. Here we have that. So all we did was copy and paste this over here, and we're just looking at the detail now. And so all we need to do then is check off everything that happened here to here and see if it all ties out. How do we want to do that? It makes a big deal that it's important to know whether we're going from the bank statement to the books or the books to the bank statement. I would start off going from the bank statement to the books and then go the other way, because when thinking about this, if it's on the bank statement and it's not on our books, it's most likely that there's an error in our books and we're going to have to fix whatever the problem is. If on the other hand it's on our books and it's not on the bank statement, then it's most likely the fact that there's an outstanding item, meaning an outstanding deposit or an outstanding check. So what we'll do is we'll just go through here and check everything off and see what happens. First, going from the bank statement to the books. As we do it, just going to highlight everything as we go. So here we have the deposit here of 50,000. I see that 50,000 here in the books. So I'm going to highlight that. I'm going to right click that. I'm going to make it, let's make it green. We found that. There's the 50,000 there. I'm going to highlight this. There's the 50,000 there. Note it might not always be in order. We see the 65 before that 50 here. That's because it might have taken different times to deposit in the bank, meaning we may have deposited one electronically while we deposited the other one by going to the bank and putting it into the ATM machine or something like that. And if that's the case, it might take the bank a different amount of time to process the checks. So the dates that the bank have will always be later than the book dates because we recorded it at the time that we made the deposit. The bank is going to have to take a little bit of time in order to process the deposit. Then we have the 65,000 here. We see the 65,000 there, so we're just going to check that off or highlight it and say, yep, we found that there, we found that here. Looks good. And then we have the 628 here. This is a deposit, so I'm just going to highlight that. I see that here. I see that here, the 628. Looks good. Then we see the 20,000 here and the 20,000 there. Looks good. Note we also see a thing that's a little bit tricky is we have a 0 in the beginning balance here, and really the beginning balance is that 25,000 because this was our first month of operations. So that can be tricky in the first bank reconciliation to get that beginning balance right. We're going to have to enter it in the data in some way. But here's the beginning balance on the books, and we're basically just going to tie that out as well. So here's our beginning balance there. We have it there, and we have it here. So when we go to record our reconciliation, we will be using the 25,000 as the beginning balance. Looking through the checks, we have this check, and if we had more detail on the books, we would also have the check number and the date. On our books here, we don't have as much detail because we are limited on space and don't want to make the thing look too intimidating. So we removed some of the detail. But just remember that these dates on the bank statement aren't something that we can tie out exactly to our books. Our books will always be the date prior to when they cleared the bank. But the check number will always be the same, or should be, and so should the amount. So those are the two things we can use to tie these items out. So here's the 12,000 there, we got that. Here it is on our books. Here's the 16, check 1002, here it is there. Here it is on our books. I'm just right-clicking and highlighting these as we go. And I know this is tedious. This is actually, the way this stuff is done here. And then here's the 7,000. We're going to say there's the 7,000. Here it is on our books. We're just checking these off, just highlighting these. There's the 400. Check. Here's the 400 on our books. We'll check that off. Here's the 598 on the bank statement. Here's the 598 on the books. And then we have the 620. Now, once again, it would skip a little bit. So we're going to say, okay, but I still see that 620 here. There's the 620 there. And here's the 15,000 here. And here's the 15,000 there. So I had to skip around a little bit, note, to get these. And we didn't see them all line up perfectly. There's some numbers in between I haven't found. And then we're looking for this 80,000 withdraw. And we don't see that here, so this and this 15, I don't see that on the books. So these two items are on the bank statement, not on the books. I'm going to make those yellow. Say we're going to have, those are the differing items. These are something we're going to have to deal with. We're going to have to reconcile. And then on our books, if we look on our books and go the other way, just to double check everything, I say, I didn't check off this green item. Do I see that over here? We're going to say, no, it's not over there. It's not in the deposits. So I'm going to highlight that and say that's a reconciling item. I'm going to have to do something with that. Same with this 11,000. I don't see it in any of the checks. So I'm going to have to do something with that. This 500, I don't see it over here at all. So we'll have to do something with that as well. This 360, we don't see over here. So we'll have to do something with that. And then same with these two here. They're not over here on the bank statement. So that's what we have here. Now, when we look at these, we might say, these must all be errors that happen here. But note that they're not going to typically be errors on this side because we're saying that this deposit happened probably at the end of the month. And therefore, it may not have cleared the bank yet. And the same with these checks. These checks could be outstanding for a pretty good amount of time because the check has to go to the mail and then the other person has to get it and then they have to deposit it. And then the bank has to talk to the other bank in order to know that the deposit was cleared before we get it. So even if we wrote the check sometime in January, it's very it's very likely that it doesn't clear the bank till sometime in February. So those are going to be our reconciling items then. We're going to say that we expect that there's going to be some outstanding checks here, and we're just going to, if we can reconcile exactly what those are, then we can double check that all other items that we have recorded here are correct and have been verified by an outside third party, a very dependable one, the bank. So what we're going to do is we're going to do a bank reconciliation. So here's the bank reconciliation. And typically in a textbook, we have two sides to it. We're going to have the bank balance and the book balance, and we will adjust them. In the bank reconciliation on QuickBooks, we didn't really have two sides, and on most softwares you would, and you really only have kind of the bank reconciliation, which is the one side. And the reason is because everything that we're going to adjust on the books, we're just going to make an adjustment for. We're actually going to fix. So after we fixed it, we will only be left with the bank balance side of the bank reconciliation. So that'll make more sense in a second. Let's go through the bank reconciliation process. What we'll first do is we'll start off with the bank balance. And so as of the end of the month, not the beginning of the month, the end of the month, here's the bank balance, 109,415. So we're going to put that here. This is the 109,415. And we're going to compare that to our books. The ending balance on our books is way down here, the 94,437. So that's going to be our beginning book balance. So we're going to say that that's 94,437, our beginning book balance. And obviously these are both as of the same date, and they don't match. And they're never going to match because there's almost always going to be some kind of outstanding item typically. So what we're going to do is just go through these items and say, is it the bank's fault, or is it the book's fault, and put the reconciling item in the correct area. So if we do that, we're going to say, if we look at the bank statement first and say this 80 and this 15, these are amounts on the bank statement, not on our books. So this probably happened, maybe we made a withdrawal from an ATM or something like that and we didn't record it. And the bank service charges, of course, we just don't see those until we get the bank statement, and then we have the bank service charges. These are items that we're going to say the bank is not wrong on this, or at least, those are things we're going to have to pay for. Our books are the things that are going to have to be adjusted. So these two items would go on the books side. We're going to say, okay, we're going to have to fix our books. Our books are going to have to be adjusted for the fact that we're going to have to pay 80,000 or 80. We already took out 80. And we got to pay 15 for the service charges, which they were nice enough to take out of our account already. So we're going to do that by saying it's going to decrease the book balance. So I'm going to say the withdrawals are going to be 80. So I'll put a negative 80. And then the bank service charge is 15, negative 15. I'm going to go over here and highlight these and make these a lighter green, saying that we have found those and put those in a particular place. We put those on our book balance to make that adjustment. Now we're going to adjust the rest of the yellow items. So we have this 956. That's going to be a deposit. It's a deposit on our books, not on the bank statement. Why? Probably we made it at the end of the month and it has not yet cleared. If we're concerned about it, then we could check with the bank, meaning this is actually being done for the time period ended January 31st. But clearly it's some period after that when we're doing the bank reconciliation, sometime after February in this case. And therefore we could call the bank and say, hey, on the bank statement as of the end of February or sometime after February, did this 956, or we can check online of course, clear? And if it has cleared sometime in February, then that's okay. Then we're saying, okay, that's good. All we need to do then for the January bank reconciliation is to reconcile the fact that it's going to be a timing difference. To do that, we're going to go up to the bank balance up here, and we're going to say that the bank balance needs to be adjusted, meaning that 109,415 is not entirely accurate. It's not that the bank really got it wrong. It's the fact that it's just a timing difference. They don't know about the fact that this deposit has happened and just hasn't cleared yet. And so they're kind of wrong just from lack of knowledge. And therefore, we're going to make the adjustment here. So this is a deposit that is included in our balance, not included in the bank balance. And therefore, it needs to go up. So we're going to put an increase here. I'm going to call it an outstanding deposit. And that's going to be a 956. It might be called a deposit in transit as well. So I'm going to go ahead and highlight that and say we found a home for that. And then a similar process is going to happen for all of these items. These are going to be the checks that were written on our books that have not yet cleared the bank. So these are items that we wrote a check for probably closer to the end of the month that have not yet cleared the bank. Once again, if we're concerned with them, we can call the bank and say, hey, did they clear after the bank closed? And if so, then we're okay. And all we have to do is really reconcile them. Same item here. The same idea is that this account, the bank balance account here, is not really right. It's wrong in that it doesn't include these items that we know about that the bank does not know about. It's just a timing difference. They will clear the bank once the bank is aware of them, but they're not there yet. So what we need to do is just add these up. We're going to say all these items are going to be the items that are going to be outstanding checks we wrote that haven't cleared the bank. And those are going to be items here that are included in our balance, bringing our balance down, not included in the bank balance, and therefore to reconcile, we will have to decrease the bank balance. So if we were to take the calculator out and just add these up, then of course it would just be, let's do that again, the 11,000 plus the 500 plus the 360 plus the 3539 and the 3630. So it's the 1629 if I did that correctly, hopefully. And we're going to do that, of course, with a formula though. So we're just going to point and click to them. So we're going to go back up here. We are in cell EK6, and we're going to select equal and just point to that 11. And it's a negative, so it's going to be decreasing here, so that's fine. And then we'll say plus this 500, so it's plus a negative, so it's going to, and then we're going to say plus this number, plus this number, plus this number, and enter. So it's going to look like this. If I double click on it, that's the formula. Once again, I'll do it one more time. I deleted it. I'm on EK6. I'm going to select equals, point to the 11,000 plus the 500 plus the 360 plus, scrolling down a tad, the 3539 plus the 630 and enter. So there's what we have there. So we're going to say then, of course, that we have an adjusted balance then of 109,415 minus the 16,029 plus the 956, and that's going to be our balance if I did that correctly. And we'll do that with the sum function here. If I sum this up, it'll take this plus the negative or subtract that plus this. So let's use the sum function. We are in EK10. We're going to say equals SUM, double click the sum function and highlight this column. That gives us this number here. And by the way, we've found a home for all these, so I'm going to make these a light green. So we've found everything now. Should be no more red, or yellow. So there we have that. And we're going to do the same thing over here, and hopefully, if we say this minus this minus this, it will be the same number. It'll be that 94,342. Let's see if that's the case. We're going to use the sum function by saying equals SUM, double click the sum function, and highlight this column. Enter. So there we have it, and they tie out. So now we've matched these out. So we've reconciled the items. We said here are the items that need to be on the bank balance that aren't included. These are the items that are correct on our books that have not yet been included to the bank and need to be in order to reconcile the bank to the books. These are the items on our books where they were on the bank but not on our books, and they're things that we are wrong on. We need to fix on our books side in order to reconcile, and then we have the reconciling items. I'm going to go ahead and underline these, just format these just a bit. We'll say double underline here, double underline there, and we'll have a single underline here and a single underline here, and there we have that. Now, what we're going to need to do at this point then is to adjust these amounts. These two amounts are things that need to be fixed because they're not on our books and they're not a timing difference. They're things that actually are going to be out of our checking account permanently. So what we're going to do is actually make a journal entry related to these two items, and then our ending balance will be in actuality this 94,342. We're actually going to add them in essence to the GL down here. Hello, in this presentation we will talk about the adjusting entries related to the bank reconciliation process for January into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. Last, if you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. Time we entered the information for a bank reconciliation. Now we're going to take a look at those adjustments that would be entered, oftentimes being revealed through the bank reconciliation process. We will first take a quick look at QuickBooks and then move into Excel and enter the information there. Within QuickBooks, once we did the bank reconciliation, we had two items that were on the bank statement, not on our books. Within QuickBooks, we typically would go in and make that adjustment, meaning we would adjust the cash account here through the cash register, meaning we're just going to enter the $15, which was the difference, and charge it to the bank service charge, reducing the checking account and posting the other side to the bank statement. And then we can go into the bank reconciliation and just check that off. So we're actually entering these adjustments as we go. We'll take a scroll all the way to the right in order to see where the bank reconciliation process is. So we're just taking a scroll all the way to the right to get to the bank reconciliation process. Scrolling to the right. Here is our bank statement and our bank reconciliation on columns DW through EK. Last time what we did was match out the bank statement and our books and reconcile the items, and we typically have two reconciling items when we think about a book problem, and that's going to be the bank reconciliation consisting of the bank balance, starting with the beginning balance and entering the adjustments in terms of outstanding checks and deposits in this case to get to our adjusted bank balance, and then our book balance, and that's going to have the adjustments to the book balance to get to our ending book balance, and of course those things are the same. Now we're going to make the adjustments, and the adjustments need to be made to this book balance side, meaning we need to make, of course, this number actually be on our books the correct number. So we're going to change this number to this number by entering adjusting entries related to these items. To do that, we're going to enter a journal entry. Now there's a problem here because if we enter the journal entry as of January, it could throw off, or it will throw off, our beginning balances. And typically that's what happens a lot of times when we do a bank reconciliation after the month has closed. And this is the issue with the closing process, and something that we need to be aware of no matter what software we're going to be using. If we go back in and adjust things into the prior date, the software may allow us to do that. QuickBooks will allow us to do that. However, if we had already generated financial statements, we'll see that the beginning balances will change if we do that. We're going to do it that way just to see how that automation process happens and see what the problems can be. So note we have this adjustment here. I'm not going to make the adjustment in this month's journal entry, as I probably should. We're actually going to go back to the prior month and enter this information as of the date that this happened, meaning this withdrawal happened sometime in January. We'll go back in January and record the journal entry related to the withdrawal. In doing so, it's gonna change the retained earnings portion. So let's check that out. Let's see that now. We are gonna go to the trial balance for the original trial balance here in January, enter the journal entry. Thinking about the journal entry now, we're gonna say it's a withdrawal. We're gonna say that cash went down clearly because we're working with the checking account. And the other side of it, we don't really know what the withdrawal was for. We're gonna put it into miscellaneous expense. So we're going to go back to the original trial balance over here. First tab, and we're going to scroll to the right till we see our journal entries. And we're going to put the journal entry in there as of 1/31. So I'm in U8. We are in cell U8. The date is 1/31, and we're going to say the checking account is decreasing. So here's the checking account. We're going to make it go down by doing the opposite thing to it, which is a credit. So we'll copy that. We're going to put that on the bottom of the date. Right click and paste 1, 2, 3, and I believe the amount was $80. So that's going to be a credit for $80, and then we'll debit something also for $80. Once again, we don't know exactly what we purchased because we pulled money out. We don't know what it was for. If it was a draw, personal use, we'd put it here. If it was for business use and we don't know exactly what it's for, we're going to put it into, in this case, miscellaneous expense. So we'll copy the miscellaneous expense, and we'll scroll back up, and that's going to be the debit. Right click on V8 and paste 1, 2, 3. I'm going to format this just a bit and indent it. Now I'm going to make this whole journal entry yellow because it happened after we closed out the date, and just meant just to highlight that fact because that could cause us problems. We will now post this journal entry to the general ledger. In order to do that, we're going to freeze the pane. So we're going to scroll up top. We're in AJ1. We're going to go to the View tab. We're in the View tab. We're going to go into the Windows group and freeze panes, and then freeze the panes. Then we're going to record this first account. Here's the miscellaneous expense. If we scroll back down, it's in the expense area. We have assets, liabilities, equity, then expenses. Here's the miscellaneous expense. We're going to go to the right till we find that. So we have the assets first. We then have the liabilities. We have the expenses. We're looking for miscellaneous. Here it is. It's way over in BO36. So we're in BO36. We're going to select equal in BO36. We're going to scroll up and then we're going to select that 80. Let's do that now. We are in BO36. We're selecting equal. We're scrolling up just a bit and we are pointing to that 80 and enter. So there we have that. It's going to increase our balance in the expense by 80. We're going to scroll back to the financial statements to see where that information is. And there it is. We're out of balance by 80. There's the 80 on the trial balance, and it decreased net income. Now we will record the other side. We're going to the other side. That's going to be miscellaneous. That's going to be the checking account. That's our first account on the trial balance, of course. Scrolling down to the checking account, the next area in the checking account is in AN26. So we are in AN26 and 26, and we're going to select equals. Scroll up just a bit and point to that 80 and enter. And that brings the balance down in the checking account, 94,357. If we scroll back up, here's the 94,357 there. We're going to do the same for the next item. So I'm going to go back to the third tab to find this. We're going to the third tab. And the next item we need to record is the bank service charge. So once again, it's going to decrease the checking account. We know that because we need to adjust the checking account. And the other side will go to some expense called bank service charges. So let's do that. I'm going to go back to the first tab, We're going to record this again as of 131 because it was for the first bank reconciliation. And then we're going to say the checking account is going down. Here's the checking account, has a debit balance. We're going to make it go down, doing the opposite thing to it, which is a credit. So copying the checking, putting that on the bottom of the date in V12, right click and paste, 1, 2, 3. We're going to indent that, go into the Home tab, go into the Alignment group, and increase the indentation. We're then in cell X12. I'm going to make the credit of 15. We'll debit something then for 15. And it's going to be an expense, and it's going to be bank service charges. Now note that some companies might not have an expense called bank service charge because it's too small, and they might just put it into miscellaneous expense or something like that. I like to put it into a bank service charge and know what exactly those charges are to the bank. So here's the expense account. It has a debit balance. It goes up in the debit direction as all expenses do. So we will do the same thing to it and debit it, copying the bank service charges, scrolling back up and putting that in V11, right click and paste, 1, 2, 3. There's our journal entry. I'm going to make it yellow again, highlighting the fact that this is something that was entered after the closing process, which could cause us problems. We then have the bank balance or the bank service charges. We're going to post that to the general ledger. Here's the account on the trial balance. It's going to be in the same order on the general ledger. Let's find the bank service charges. We have the assets, we have the liabilities, and then we have the equity. We're looking for bank service charge. So let's scroll up just a bit. Don't see it there. Here it is. It's in BK39. So we are in BK39. We will select equals. We're going to scroll up just a bit and point to that 15. Let's do that now. Scrolling back down, we are in BK39. We're selecting equals, scrolling up just a bit and pointing to that 15 and enter. So there's the bank service charge. We should find that on the trial balance as well. Scrolling back to the trial balance, all the way back to the trial balance and scrolling back up, we see that the 15 is here, bringing net income down, and we're out of balance by 15. Now we're going to record the checking account. Here's the checking account. Here's the checking account on the trial balance. We will be in the next open area. That's going to be right here in AN27. We will select equals, scroll up just a bit, and point to that 15. So in AN27 equals, we're scrolling up just a bit and pointing to that 15 and enter. Now we're going to see what the effect is on the financial statements. So in order to do that, we see that we adjusted the checking account here. So I'm going to go ahead and point to that on the financial statements. And we see that we also made an adjustment to two expenses, one to the bank service charges. I'll point that to the financials. And we made an adjustment as well to miscellaneous. So we'll point that to the financials. I'm then going to unfreeze the pane. So we'll scroll up to the top and we'll go to the View tab and the Windows group and the panes, unfreeze the panes. Then we'll take a scroll to the right. We're going to look at what happened to the financial statements. Scrolling all the way to the right, taking a scroll to the right, we see the financial statements on columns BW through CC, and we see that cash has changed, and note that we also see that the equity has changed. So equity is something that has been updated now, and that's really what the problem is, because really we have already closed out this financial statement. If we had already closed this out, if we had already generated the report and given it to somebody, then this ending balance here in the equity as of the point in time of January 31st, should be the beginning balance for February. And what we have done now is adjust this ending balance after it has been closed, which will give us a problem in terms of our beginning balance for the next month. So that's really why we need to really be careful when we make these adjustments to QuickBooks or some accounting software for a prior time period. Software like QuickBooks really allows us to do that. However, it causes us problems if we had printed the report and we're going back to the reports and trying to say, our retained earnings doesn't tie out. How does that happen in detail? Well, we see that we made adjustments to 15 to the expenses and 80 to the expenses, and we see that that is part of net income. Net income is revenue minus expenses. And remember, this is for the month of January, and therefore that net income is going to be part of the statement of owner's equity calculation. Here's our beginning balance. Here's the investments. This number then is now different than it was when we had already closed out the books, when we already issued the financial statements at the end of January. And therefore, this change is going to change that beginning balance, and that then changes the ending balance. That's why our ending balance now for equity is now different. To see this problem more clearly, let's take a look at the closing worksheet. This is our closing process worksheet. We're going to go to this next worksheet, and remember the closing process, what we did is we said we're going to close out all of the income statement accounts to equity, and in so doing, we will then be ready to process the next month. In other words, revenue and expense accounts should only go up over a certain time period. If we want to count what happened during the month of February, we cannot start with the January numbers. We have to make them 0, as we did here. We took it out and we made it 0. So we did that, and we made all of these accounts 0 as of after we recorded all the journal entries for January, and we had a post-closing trial balance, which in essence was just the balance sheet or permanent accounts, these accounts up top. Now that we go back in here and we look at it and we go through all these accounts which should be 0, we all of a sudden have, this account just popped up and it's not 0 anymore, and this account just popped up. Of course, the 15 bank rec and the miscellaneous. And those are going to be items that we have now adjusted, and therefore it throws off our closing process. We no longer have the correct closing entries over here because we used the prior balances. We're out of the closing process is wrong by the 15 and the 80. So that's just to show that this beginning balance then is not correct when we look at the trial balance for the next month. So let's go look at the next month now and see if we can make sense of this, just to make sense of this problem. We're going to go to the trial balance for February, and then we'll go to the financial statements. I'm scrolling back to the financial statements. So we're going to the left, and we're looking for the financial statements on the left. And here are our financial statements. We have the balance sheet. It's in BW through CC. These are going to be our items here. What has changed here, note if we scroll down to the statement of equity, we see the beginning balance in the equity section being this 144,175. That should match the ending balance that we have for the first month, the month of January. And there's going to be a problem between those two. If we go back to January, this number here, 144,175, should match the ending number for January. Let's go back to the first tab and the trial balance. We're back to the trial balance, and we are over in BW to BY in the financial statements. This ending balance, this 144,80, doesn't match what we have. If we go scroll back, this is the ending balance for January. which should match our beginning balance, going back to the third tab, the trial balance for February. That should match our beginning balance. It doesn't, and the reason is because we made that adjustment to the financial statements afterwards. Let's see where that adjustment is just on this worksheet to see where the nature of that problem is if you run into this problem, and you will if you work with QuickBooks or financial statements much. And we will then see that those two adjustments happen to miscellaneous expense and the bank service charges. So if we go through these expenses, note they all have zeros in all the expense accounts, zeros in all the expense accounts, but miscellaneous now has a beginning balance of 80. And that doesn't make sense for an expense account. It should be 0 because we're starting from 0 and counting forward for the month of February. We of course see the same problem for the bank service charges. That should be 0, it's now 15. Where are these being drawn from, these amounts? They're coming from the tab of January close and that cell I-28. So if we go back to the January close tab, we see the 15 here and the 80 here. That's where they're being drawn from, and that's where the problem is happening. So we're going to go back to the trial balance. Now we're going to go back to the financial statements. So I'm going to scroll all the way back to the top and then go to the right till we see these financials. Here we are in BW to CC. And the bottom line of this is that the financial statements, if we're thinking about a 2-month time period, are okay, they're correct, they're in balance, total assets still equal total liabilities plus equity. We're not out of balance. The only problem we have is that if we had printed the financial statements for January, then our equity at the beginning balance of equity, scrolling back down to the equity, the beginning balance here in February will not match the ending balance of January, and that could cause a problem. So generally what we want to do is do the bank reconciliation soon after the close of the month, make any adjustments we need to, and then close the month, and be very careful about recording anything prior to that. If we do find an adjustment like this and we need to fix it, then it may be possible to expense those items in the following month, in February, so that our beginning balance ties out and we still have at least recorded these expenses in one of the 2 months. Hello, in this presentation we will create a bank reconciliation within QuickBooks Pro 2018. As we do this, we will be working with the first bank reconciliation for a new company, which can cause problems when we have that first bank reconciliation. So we'll discuss some of those problems and how those problems can be fixed. If you've been following along with us, we will be continuing on with the Get Great Guitars problem. If not, that's okay. We will be doing a bank reconciliation, the first bank reconciliation for the company, and looking at problems related to finishing the first bank reconciliation. If you have the backup file up to this time, you can say File and restore the backup file, that giving us the data so that we can reconcile that data. If you've been working through the problem, we should have similar data, but the backup will get you right to that point to make sure we're on the same page. We have the Open Windows open. To open the Open Windows, go to the View tab, and we want to select Open Windows List. And the only open window is the Home tab. To open the Home tab at here, Company Home Page. That is where we are at. What we're going to do this time, what we have done so far for this project, is we have entered a new company. We're a merchandising company. We put all the beginning balances in there prior to the 1st January that we are going to start operations, which we're saying is January 2021. And then we entered data for January and February. We have not yet reconciled either January or February. We're going to say now we've got the bank statements, and we're going to go ahead and use those bank statements in order to reconcile the bank accounts. This is going to be one of the most important things that we have to do in terms of the double entry accounting system to make sure we're doing things correctly. Cannot emphasize this enough. If you can reconcile the bank accounts, then you have some pretty good assurance that you have the information into the system. It may not be in the system totally correct. It doesn't mean there's not errors. But one, the system is giving the check of having the double entry accounting system, meaning debits will equal the credits or assets will equal liabilities plus equity just by using QuickBooks. And then if we can reconcile on top of that, that means that an outside party that means that the bank is actually checking and verifying every transaction that we have that goes through cash. And cash is going to be involved in any of these cycles, whether it be the vendor cycle, customer cycle, or employee cycle. The timing difference will be different because we are on an accrual basis. But by us reconciling the bank account, we're really giving a check not only over our checking account, not only over just our cash account, but also giving some verification over every cycle in the process. And therefore, the reconciliation is not just a check to see if the bank made an error and make sure that the bank didn't make an error. It is a huge check against theft happening and problems of that nature, but it's also a huge check just in terms of everything, every system we have. So it's our second biggest control. If you're using QuickBooks and you're putting all the data within it and you're able to reconcile, you can have some pretty good assurance that at least the data is in there, and we have some pretty good numbers that we can work with. So in order to do that, and by the way, if you don't have the bank reconciliation reconciled, then a lot of times I wouldn't have a whole lot of faith in that all the data has been input to the system, or that it's all been input correctly. It may be, it may not be. Most likely there are problems and there are errors. We'll still have some information that's relevant in using the double entry accounting system to input that data, but this check is pretty crucial to really have trust in the financials. So let's take a look at what we have so far. We're going to go to Reports, we're going to go to Company and Financial, and we're going to scroll down to the balance sheet. And we're going to put the date here. It's going to be 01/31/21. So that's the end of the first month that we have operations in. Now, we're going to compare this number in the bank statement to this is our books, to the bank statement. So what we're going to have, of course, is a bank statement by the end of the year. And you would think that if everything was done well, that the number would equal on the bank statement this $94,436.17, and everything would be great. And we would have a verification from the bank that that number is indeed the correct number as of January 31st. However, it's never going to be the case where that number is the same unless we have very few transactions, because there's always going to be some timing differences. So if we think about our personal checking account, if we wrote the rent check today and then we went to the ATM and checked our deposit and it didn't include that $500 or $5,000 or $1,000 rent check or whatever, then we're pretty confident that that amount that's in the bank is wrong by the fact that they haven't yet received that outstanding check. And that's going to be the case where we're always going to have a difference in terms of outstanding checks and possibly outstanding deposits, meaning checks take a while to clear, and therefore when we write a check, when we send a check, then someone else has to receive it. They have to put it in the bank, and then the bank has to somehow talk to our bank or get to our bank to talk to it in order for our bank then to process the check being withdrawn from the account. So what we're really going to do is we're trying to narrow down the differences to just being those differences in outstanding checks. And if we can do that, then we can say that everything else is correct in that we have a double check by a third-party bank checking off every other check that we have written. So our goal here is to reconcile the difference between this checking account and whatever it says on the bank statement. And by doing that, we're not really looking for those differences just to find the differences. We're trying to find the differences in order to then say that everything else that has been input thus far is correct. And that's what we're looking to do. So let's take a look at the bank statement. Here is an example of a bank statement. So we're going to have the bank statement for January 31st, 2021. Typically, we're going to have a recap on the bank statement. We're going to say this is from the bank. Obviously, this is an imaginary statement, but this is a bank statement. We're saying from our bank. And it started off with $25,000. That's the beginning balance that we'll have in the bank statement. And that's really what we started off with. We entered that amount into our checking account as a beginning balance, but that's one of the issues oftentimes people have when reconciling the first bank account. So we'll talk about that beginning balance. Then we have the additions and the withdrawals and subtractions, giving us our ending balance. Therefore, this is our ending balance for the bank statement. We had $94,436.17 on our books, and that's going to be the reconciliation. As of the end of the month, what is the difference between those two, and we're going to find and try to narrow down that difference to just timing differences. Then we have the deposits by date, and then we have the checks by date and also by check number. So we can check these off in a couple different ways. We got the check number and the amount and the date. And then we have some other things that aren't checks that are going to decrease our deposit. Here we just have withdrawals and bank charges. We could have other items down here like non-sufficient funds and other types of items that would be down in terms of other types of transactions that would decrease our bank account from the bank statement side. So our goal is to reconcile these two amounts. So let's go back to QuickBooks. Remember that this $94,436, that's what we need to reconcile to the bank statements $109,415. In order to do that, we're going to go to the banking up top, and we're going to reconcile the bank accounts. So we're going to go to Reconcile. This will be our reconciliation screen. We're going to reconcile as of the date of January 31st, 2021. That's the first month that we have actually started inputting data. We then have this $25,000 as the beginning balance. That's the beginning balance we set in our checking account as we set up the checking account. This is one of those points that if we had not set up this $25,000, we could try to go back in now and set up the beginning balance, that balance being the balance from our prior bank statement, meaning it should be the ending balance on the 12/31/2020 bank statement, and that then is where we're going to start from this point. So we need to have that beginning balance in there either in this form here, or note that we need to include it in the check register at some time, typically before the date that we're starting to input data into, so that it doesn't affect our income statement on the current date or any of the balances on the current date. It just gives us the bank balance as it needs to be in accordance with the bank statement. And then we can check it off when we go through the checking off process. So it needs to be in one of those formats, either here in the beginning balance or input into the check register so that we can check it off as we go through the process. That's one of the tricky parts of doing the first bank reconciliation. Once it has been completed, once you've done the first bank reconciliation, the beginning balance should always be the same as long as we've completed the process correctly, because we will end off with the ending balance of the prior bank statement, which will always equal the beginning balance. So we have some assurity, and you'll be very confident with that once you start doing the bank statements a few times. But the first one, oftentimes we don't have a lot of confidence with it when we're first, learning the first bank reconciliation. Okay, and of course the first one is the most difficult technically as well. What we're going to do now is put the ending balance from the bank statement. And remember, that was 109,415. We're just taking that number directly from the bank statement as the ending balance, the bank statement being what we received from the bank, giving us that ending balance. This other information, we have a service charge. Oftentimes we might have service charges. We saw that we had bank service charges of 15. We could input that here and record that, but I recommend not doing that because it kind of muddies the waters when we're trying to figure out the reconciliation. It's easier in some ways to just put that in place in the register or some other format so that when we reconcile, we can check it off. So that's what I'm going to do. That's what I'd recommend doing. We could have interest as well, meaning we might have earned interest on the checking account, and we could input this here, but again, that might make the reconciliation a little bit more complicated to understand. Therefore, I recommend just putting in the interest as a journal entry or into the register so that we can see it in this process, and that will make more sense once we do this. So I'm going to say continue now, and this is what the bank reconciliation screen looks like. So we have on this side the checks and payments. So this is everything decreasing our books in terms of cash, and we have the date, we have the check number, we have the payee, the amount. And the check number and the amount are really the most relevant, and then of course the date. However, the dates are not always going to follow through the bank statement because of those timing differences, whereas the check numbers and the amounts should tie out exactly. On the deposit side, we have the date, and really the only other relevant item is the amount. And so that's how we're going to have to check off the deposits. Now, typically there are less deposits, so they're going to be easier to do, even though we don't have that added set of data being the check numbers for them. at the bottom here, we have our reconciliation. The difference right there, that needs to be down to 0. Once that is at 0, then we should be reconciled and everything is good, meaning the difference between our books and the bank has been reconciled. So what this is saying is that this 25,000 is what has currently been cleared. That's our beginning balance. And if we are able to check everything else off in terms of everything that's on the bank statement to what's on our books, then this balance should go down to 0, and we should have found the difference, and that will bring us in balance. So we're looking for the cleared balance to equal the ending balance of the 109,415. As we do this, I'm going to try to put this side by side as much as possible, but not make the screen too small as much as possible. So here's our book balance. Here's the bank reconciliation. Here's QuickBooks. Here's the bank statement that we're looking at, or part of the bank statement. And what we need to do now is just all we do is go through this and tick and tie out to just check off the bank statement to the books. So we're just going to find each amount on the books and tie them out to the bank statement and check them off. Anything that hasn't been checked off will then be the differences. What's going to happen in practice is we're just going to say anything that's on the bank statement, typically, if it's on the bank statement and not on the books, usually that's something we need to adjust on the books. Usually that's something we need to fix on our side. For example, we have down here the service charges and the bank and the withholdings. Those are not going to be on our books yet. We haven't input them yet. Those are things we're going to have to fix. So we're going to actually go into the check register and fix those as we see those, when we see those differences. If on the other hand, it's something that's on our books that's not on the check register, not on the bank statement, I should say, then it's most likely something that is outstanding. And that means that it should be okay, because it's going to clear in the next month in February, and we'll see if that is the case when we do February's bank statement. So those are just the timing differences. Those will actually be the reconciling items that we're looking for. So if we go through this, on this side we see the checks. So this is going to be the first things we're going to check off. Here's our check numbers on the bank statement. We have the date, we have the check number, and the amount. Here we have the date, the check number, and the amount. All we're going to do is tick and tie these off. I'm going to try to do this side by side as best we can. So here's this one. If I had a highlighter, I'll just highlight this whole thing. I'm going to say, we have found that, and there it is there, and then check it off on this side. Next one, we see the 16. I would highlight that and check it off on this side. Next one, we see the 7,000. Note the dates are not the same because they cleared later, always going to be later on the bank statement. But the amounts are the same and the check number is the same. So all we're going to do is just say, we found that one, check it off. Next one, there's the 400, there's the 400, we found that one. We're going to clear that off. There's the 598, there's the 598, we found that one. We're going to go ahead and check that off. And then I don't see this 11, I see the 620. That's the next one we have, number 1008. So we're going to check off the 620 and skip those other two. Found that. And then we see the 15. That's going to be down here, check number 1010. So we find that. And there are the withdrawals. Now, we don't see the 80 or the 15 over here. That means we're probably going to have to fix it. And we see these other checks that were written in January. This check number 1006, 1007, 1009. Those are in our books, but not over here. But we're not overly concerned with those because it looks like those were written at the end of the month, and therefore we're going to have to check them off probably next month. So if we were concerned about those, especially like this check here, we might want to make sure that that has cleared. We can call the bank and say, hey, did that clear in February? If it had, then it's just a timing difference, and we're okay with it. We'll pick it up on the February bank's reconciliation, as we'll see. Let's take a look at the deposit side now. Here is the deposit side in QuickBooks, and here's our bank statement. So we're just going to go through the same thing. So we got the 50,000 here. We see that, so we're going to highlight that and check that off here. We see the date's different again. The date is going to be different than the date here, but the amount is the same, and so we're going to have to basically go through that. It should be easier for us to tick and tie these out, even though we don't have the extra reference of the check number because there's fewer deposits, and we grouped them properly, hopefully, so they'll be in the same grouping in the bank statement as we go through this. That's part of the benefits of grouping the deposits together and going through that undeposited fund process in the when we enter the deposits. So here's this number. There's the 65, there's the 628, there's the 628, there's the 20,500, there's the 20,500. So we have found all that, and if we look at our reconciling item then, we see that we're off by 95. That 95 is the difference from our bank statement that we haven't yet found a home for, because they haven't been input in our system yet. So all we need to do is find a home for these. We need to input this item into our system, and we should be okay after that point. Note that we do have this deposit on January 28th that didn't clear here. It's not on the bank statement, and that might be concerning. We might want to call the bank and say, hey, did that clear? As of the end, it's been 3 days. Did it clear in February? If it had, that's okay. Then it's just a timing difference. We're just going to reconcile it, note that it is a timing difference, and move forward. Now what we will do is take this 80 that is on the bank statement and enter it into our books in QuickBooks. There's a few ways to do this. I'm going to do it what I believe is the easiest way, and that is by the register. So we're going to select banking. We're going to go down to use register. And it automatically opened the checking account because we have the bank reconciliation open. And I'm going to enter it as of the end of the month, 01/31/21 being the date. It's not going to have a check number. I usually put something else like other in there, some other reference number. And I don't know who the payee. It looks like a withdrawal that we had, so we might have gone to the ATM or the bank and pulled out money and not reference where it was going to. And so we're going to put 80 is the amount that's going to have to be decreased. Now we don't know where it might have been a draw that we took money out of the business checking account for personal use, or it might have been a business expense that we pulled money out. We're going to assume here that it is a business expense that we used the money for. This is one of the things that we have to go through when we see these differences on the bank statement from our books and enter them into our books. We know that the cash account needs to go down, but we also have to have some other account for our reconciliation process. Typically, it would be some kind of expense if there was a decrease on the books. It might be draws, however. So if you took the money out, if we took the money out for personal use, we should select draws or the capital account, so it's not decreasing our net income because it's not really part of the business operations. And if it's, so in that case, we would use the capital account. So if it was a draw and you were looking for a draw, we do have an owner's draw. You can put it in there. If you don't, you can put it into the equity account. You don't want to put it into an expense because that distorts your income statement. It puts personal expenditures on the income statement, which we typically do not want to have there. We're gonna assume that it was for the business, but we don't know exactly what it was for. So I'm gonna make an account. Our favorite account is a miscellaneous expense, and this is where we're gonna put expense items that we don't know where to categorize, or they're too small for us to categorize them into another grouping or category. So we're gonna say tab, and we're gonna set that up. It's gonna be a setup. It's going to assume that we want it as an expense account. It is correct. We want it as an expense account. So we're going to keep that. Everything else will remain the same. And we will save and close. Now, in order for it to record, we have to select enter. So we're going to enter. And there is that item. If we then go back to the bank reconciliation in our open windows, it should appear there. There is the $80 right here. Just going to check that off. Now we're even closer. We're only $15 off on our reconciliation. That 15 is, of course, this bank service charge. So that's going to be the next item we're going to input into our check register. Going back to the check register in our open windows, we're going to select 131 again. Once again, I'm going to select Other. And we could put the bank name, but I'm going to leave it blank here for the payee. And we're just going to put the amount of 15. And then I'm looking for a bank service charge. And this, we do have a bank service charge here that was set up. So I just type that in there. We have it there from the setup when we created the QuickBooks file using their chart of accounts, that chart of accounts being for a merchandising company. So QuickBooks will set that up. If not, then you can go through the same process, bank service charge or service charge of some kind, and then add that account, make sure it's added as an expense type. And once again, we want to make sure that we select Entered so that it does record. Otherwise, when you go to the bank reconciliation, you will not see it. And then we're going to go to the bank reconciliation, open windows. And then we should see that 15, there it is, the 15, and that will put us back in balance. That's going to be it for the checking these things off. We're going to finalize this, but before we do want to point out that this is a bit more simplified than some cases may be if we had not just started the bank account right before we had the first month of operation, meaning if we didn't just start writing checks in January, the first month of operations, we may, and most likely do, have checks that were written in December of last month that are clearing this month because they had not yet cleared. In other words, we're going to have outstanding checks and possibly outstanding deposits as of the prior month. So in this example, we started off with a beginning balance, which we could get from the bank statement, and we would get from the bank statement of last year of $25,000. That's fine. We can enter that beginning balance. We put that in the beginning balance window. If we had not had it in the beginning balance window, we could just put it in as a deposit before the month that we are starting, and then just check it off on this side, and we'll still be reconciling. However, if we have some outstanding items that we wrote checks for last month that are not included in the first check that we wrote in this first month of operations, in other words, if this check right here of 1001 is not the only check that cleared, or not the first check that cleared in January, but there were checks that we wrote in December which had not yet cleared the December bank statement but were outstanding, then we'd have to enter those here because those outstanding items would have to be checked off here. In order to do that, all you'd have to do is go to the checking account and then enter those outstanding items here. Just make sure that the date is before the current date of operations. It's in December in this case, and that way it'll record it as of December, and any expenses related to that will then clear off in December. It won't affect your income statement in the current month that we are working in, and you can just enter that data. If you wanted even to enter it as a lump sum data for all the outstanding items in order to reconcile for that first month, you can do that, although putting the detail in of each check that is outstanding would be the preferred method. This first reconciliation is the most difficult because of that problem, these problems of having these outstanding items and putting that beginning balance in place, especially if you are working with a checking account that had not been started. I mean, it had been in place, in other words, before we started using it to reconcile our books within QuickBooks. So you want to enter those checks. Once you would enter those checks as of December of 2020 in this case, then you would go back to the bank reconciliation and you can check those off, and those will be the differences that you will need in order to remain in balance. If that doesn't quite make sense to you, wait till we get to the next month, and that might help out with that process, because we'll have that same issue here in that these checks were written in January, but they're not going to clear until February. So when we do the February bank reconciliation, we will see that these items will clear in February. We will have to check them off in February, even though they're in our system in the books in January. So we're going to go ahead and finish this. We're going to reconcile this item. Note that if this is not 0, it's going to give you an error sign and say this is not reconciled, and it's going to ask you if you want to force it to reconcile. I highly recommend not forcing it to reconcile most of the time. Maybe you have to on this first bank reconciliation, but by forcing it to reconcile, it's going to make it do a journal entry. And when it does that, it really defeats the purpose of the bank reconciliation, because again, you have no assurance that everything is checked off, that everything is input, because you don't know exactly what that difference is. And it could be a combination. If this is off by $5 even, it's not just that your cash is off by $5. It could be that you have a deposit of, say, this $12,000 that's off, and then a bunch of checks that are not in there, and it could be a significant difference that a combination of things that are a problem, throwing your balance off by only $5. If, on the other hand, so any balance that you have that is not completely reconciled really declines the level of assurance that the bank reconciliation gives. So you really want to look at it, and if you have the beginning balance that's the same, and you're able to check everything off, it really should be not too difficult to check everything off and bring this into a reconciling point. And if you have to go in and adjust things, you'd rather not adjust it here. You'd rather not force it to make a journal entry. You'd rather go in here and do whatever you got to do, like record that, for example, our $80 to the miscellaneous expense that we didn't know exactly where it went. We'd rather go in there and recognize it and put it to miscellaneous rather than just allow QuickBooks to force the journal entry for us. So keep that in mind. We're going to say reconcile, and it's going to say QuickBooks is giving us some information about the services. So I'm going to say OK here. Now, when we have this screen, typically you can print this. You really want to print these in some way, probably just as a PDF file, but you want to have them printed in some format, because once you reconcile multiple, you can't really go back to these reports as easily oftentimes as you can with other reports. So that means that you want to have the hard copy of the reports, so that if there are problems, and there could be problems later on, if we say delete checks or something like that, then you want to have this detail. So you want to have at least the detail, so you have the detail, and I usually say both, the summary and the detail. So we'll take a look at both. So let's display them. So I'm going to say display and say OK, and then we're going to print these or export these if they allow us to export them to Excel. So here we have the bank reconciliation. This is the summary report, and what we're saying here is we've got the beginning balance is the $25,000. Then we had these checks here. There's 9 of them that have cleared, and the deposits 4 have cleared. So that gives us the total cleared transactions, the 84,415, giving us the 109,415. This is the cleared balance, meaning these items have all passed, they've all cleared the bank, and have been checked off in our system. That then is the bank balance. This here, that's the bank balance. What we're looking for is the difference between the bank balance now and what we currently have. If we go back to our balance sheet in the Open Windows item, we see that our checking account is now at $94,341.17. We adjusted it slightly for the $80 withdrawal that we just input into the checking account, and the bank service charges of $15. If we go back to the bank reconciliation summary, we see the $94,341.17 here. That's the register balance. The difference between this $109,415 and this $94,341.17 are the outstanding checks. There's 5 of them at the $16.29, and the deposits of 1 of them outstanding of $9.55. So this is exactly what the difference is in terms of these 5 checks. That 1 deposit have not yet cleared. That is our book balance. That's the bank balance. This is really the reconciliation portion of this report right here. That's what we need to do. And then we have the new transactions. This is saying that there's 12 checks and payments that are new, and deposits and checks that are new. This giving us the ending balance, our latest balance. In other words, if we go back to our balance sheet over here, and we go to our latest point in time, changing the date, for us, we can change it even to the end of the year, 12/31/21. Then we're saying our latest balance is $99,115.56. So that's going to be where we are at the latest point in time. So if we go back to our bank reconciliation, that's the latest point in time. So as of January 31st, this is really what we're looking for. If we double click on this, we don't have the drill down features here. So note that you don't have the drill down features to get these 5 checks or this 1 item. So that means that you do have to have the balance detail. And so I highly, highly recommend printing out the balance detailed report as well. So we're going to go ahead and export this by going to reports up top. We're going to create a new worksheet. And then we're going to place this into a new workbook within Excel. We're going to export this item. And once we do this, it should generate an Excel sheet and export this to a new tab within the Excel sheet. And it has done so. So here's the Excel sheet that has been generated. Now I'm going to adjust this a bit. We're just going to go to the View tab. We're going to go to the Windows and the Split, and there we have that. I'm going to double click on the name, and I'm going to call it Bank Rec Summary. And there we have that. And then if you know that the header, once again, if we go to the page layout, we see that it does have a header if we were to print this out. Back to the normal view. Then I'm going to save this. We're going to go to File, Save As, Browse. Going to go to Desktop where we got this information somewhere, hopefully. Get Great Guitars. Going to add a new section. New Section 9. And I'm going to put that Section 9 Reports. And that will be that. Yes. And close that out. So then I'm going to close this one. Well, let's keep it up. I'm going to go to the bank reconciliation detail in the open windows now. Now this gives us the same information, but it looks a bit more messy, but this is really the report you want if you only save one of them because it gives you that detail, and you really would like to have that detail if you have to go back and look at it. So it's going to give you the beginning balance, and then it's going to give you the cleared transactions. Here's everything that cleared. And this is not as important of the information because the fact that it cleared means it's on the bank statement, which if we have the bank statement, we have that. So these are the stuff that we checked off. It cleared the bank statement. Then we have that cleared balance, which is the 109,415. That's the amount that is on the bank statement as of January 31st. And that equals what has cleared our, the cleared balances that we checked off here on our books. Then we have the detail that's really important. The difference between this number and our book number, the 94,341.17 on our balance sheet versus what's on the bank statement, is the difference of these outstanding checks. The 106, the 107, and so on, these being the amounts, that 1629.33 is the difference. Then we have an outstanding deposit, which is 955.50. That is exactly what the difference is to get here. So we know exactly what that difference is, therefore everything else is correct, and we know these are correct for sure because they cleared the bank and we checked them off. And then if we go down here, these are going to be the new transactions, again, not as relevant, not as important, but they're going to bring us to the current balance, the latest balance that we are at. So I'm going to go ahead and export this too. We're going to go to Excel, and we're going to create a new worksheet. And we're going to put that into the existing workbook that we have just created. And I'm going to browse and make sure that we have it there. So it's Section 8 Report. That's where actually that's not where I want it. I want to drop down, go here, Section 9. And that's the one we want. Double clicking and exporting. It should then open Excel and put that, export that information into a new tab within Excel as it has done here or is in the process of doing. And then I'm just going to pull that screen over and adjust it. So we're going to adjust that a bit. So here we have this, and I'm going to go to the View tab. We're going to Windows group, take the split screen out. I'm going to pull this to the right hand side so it's in order of when we printed it. Double click, Bank Rec Detail. And that's going to be the Bank Rec Detail, and it will have the header on it when you print it by going to the page layout, this little icon here. You can see that the header is there. Now if you were to print this, you would want to format it a bit nicer. If we go back to the page layout, you have, let's go back to the page layout, this information here. Now, obviously, if you're going to give this to somebody, then the summary is nicer to give to somebody because it gives you a nice little summary. But you really want the detail if you really want, to have this information. If you're going to print this out, you'd want to go to the File tab. You'd want to go to Print. And then we can try to get this on one page wide. And then if it's a few pages long, that's okay. So in order to do that, you'd probably want to adjust this to Landscape first. And that'll make it closer. Let's see if that does it. And that actually pulls it all into one page. So that's good. If we go back to the File, Print, and scroll down, we see that it's 2 pages long, but everything's on 1 page wide. And that's typically not bad, so that's pretty good. So that's going to be that for the bank reconciliations for January. Next time, we'll do the bank reconciliations for February.